All right, so that may not have been what the front-running market would have expected today, coming from the FOMC with their rate. Obviously, the 25 basis point rate hike is about what everybody expected, but coming out of it, probably not so much. I think the market was looking for the Fed to be a lot more dovish than it was, not just anticipating or pointing to a pause, but actual rate cuts by the end of the year, and that just wasn't the case. And so the markets kind of held up pretty well through most of the press conference, up and down, pretty much hanging on every single answer to every question that Powell was getting. But then in the last half hour, once the press conference was done, then that's kind of when everybody just headed for the exits. So a pretty significant decline into the end. We're going to break down just how significant it was. Has this bullish rally been the fake out that we've all been talking about, at least so that we've been talking about here in these videos for the last little bit, or are we, and we're going to start a bearish move, or was today just kind of a nothing burger, and we're just going to continue this rally we've been on, fueled by a very, very small portion of the market. We'll talk about that too. So we'll break all that down in today's video. What's really driving big moves, not just in equities today. So we'll take a look at some of the other asset classes too, and how that impacts our expectations, how the sector rotation has been. Very interesting pattern there. And then our trade ideas of stock, just in case we do get that rally. We've got plenty of bullish trades on. So and especially in previous videos, we made lots of bullish or bearish trades, excuse me. And as well as in our class portfolios at Market Scholars in our trading rooms. So we decided today, okay, if we're going to have something bullish come out today, even with that last half hour, if we're going to have a bullish move, how can we take advantage? What can we put in our portfolio to take advantage of that? So that's what was our trade idea. So let's go ahead and get started. Today is Wednesday, March the 22nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon or the red subscribe button down there. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including our Market Outlook live video that I do. All these on Monday, Wednesday, and Fridays. Come down here to the bottom, click this heart. Look at that, 118. You guys have been knocking it out of the park lately. Well above 100 on the last so many Market Outlook videos. So thank you all very much for doing that. Again, clicking on that takes you to this page. Hit that like button. Same thing here. Click that thumbs up icon. Like it there. Again, the more you do that, it really helps us so much. That's why we always ask for it every day. It gets our content out to all of our followers on those platforms. The more you like and retweet and comment on the video. So those who do that, thank you very much for doing that day in and day out. Those who don't, you can do right now with one or two really easy clicks while you're watching the video. All right, let's take a look at the S&P 500 first with the market forecast indicator. Here we are closing, filling in the gap from yesterday, finishing filling in that gap, closing back down off of the moving average by 1.5%. That's not considerable. It's not, it's not like we're now all of a sudden tanking. We were above the moving average at the highs of the day today. But the momentum line did drop to extreme lows. Again, it doesn't do that typically in bullish moves, at least that extreme. The near-term line, again, had gone farther than what the momentum line had told it to go, is now potentially forming another bearish peak like this one that it formed when it doesn't stay in the reversal zone for very long and comes right back down. It's already out of bullish territory, crossing below market sentiment. Potentially could cross below. If it follows a market momentum line, which it generally does, you would expect that it will fall, break below the intermediate line here pretty soon. The intermediate line itself is still in bearish territory. So, the short-term sentiment looks like it's weakening. That's not surprising. We're closing below the low of the high day, so to speak. So, very similar to what we saw last time we hit the moving average. And, lots of fake outs. The market dislikes to fake you out, and it does it all the time. In this case, because the long-term trend's bearish, the fake outs just happen to be to the upside instead of to the downside when you're in a bullish trend, which is what we're mostly accustomed to. And it appears that this move, again, like we've been talking about the last couple of market outlooks, appears it has a lot of characteristics of a fake out pattern. And it kind of played out a little bit today. And again, it's only one day, and we need to follow through on that. But it was, it wasn't that 1.5% loss, really even right when the press conference ended. A lot of this loss came at the very, very end of the day, after the press conference was over with. You can see when we were, kind of during the press conference, we were fluctuating up and down. It was the last, what is this, a 15-minute chart? A 10-minute. This is the last half-hour trading that we went from 398.95 and closed at 392.07. Now, we're up a little bit in the after hours, up to 392, but still, I mean, that's down, from 398.95. We're still down 6 points, even in the after hours from where we were just 30 minutes before the market ended. So you can kind of see where a lot of the decline occurred, and again, how we follow through with that's a bigger story than the fact that we did drop. Obviously, we filled in that gap as you expected that we would. It wasn't a runaway gap. We already filled in some of it. I'm talking to the market scholars in some of our classes that we're kind of hoping that it wouldn't, right? Because we all want the market to go higher. So we're kind of hoping that it wasn't that it was about as runaway gap as you could possibly get. And of course, knowing that it was most likely a common gap, and knowing that I still expected that it would fill it in, and I didn't expect it would fill it in a half an hour, but it did. In fact, it actually filled it in the last 20 minutes, because it kind of got to the gap previously, but got back above it, and then in the last 20 minutes filled in the gap. In the last 10 minutes filled in the rest of what it didn't fill in yesterday. And then some, right? Because we went below the low point. We did not go below those lows, but we did get a higher high today, but a much lower low. So that kind of plays into the pattern that we're seeing here. Let's take a look at like the Russell 2000, which has been the most bearish index. Obviously, it's down almost 3% today, down nearly more than 7% below its moving average. It also formed a bearish near-term peak. It barely got above market sentiment, but barely got in the bullish territory. Is already rolling back down. Intermediate line's already bearish. Momentum, pulling the near-term line down with it. Market sentiment's falling. It's not very low. You notice it's not as low as like the S&Ps, which is finally starting to pick up a little bit to the downside. I mean, they're about at the same level, so the S&P is light green shading in a red lines, whereas the Russell 2000 is dark pink shading in a red line. Of course, your NASDAQ, which has been the most bullish, a little bit of a bearish pattern there. Again, the second time trying to get up to that exhaustion peak, right up to that 38% retracement level of this correction. Trying for a second time to get through there, looking like it probably won't. And we talked about that divergence in class today, between the near-term line and the momentum line. Now the momentum line is dropping down to extreme lows. The expectation is the near-term line will follow suit, right? That's generally what it does. In fact, there's a little bit too much fluff here. It went up farther than it probably should have. As we all know, the NASDAQ has had a really tremendous run as a safe haven trade, but obviously not continuing that safe haven anymore today. The Dow Jones also rolled over more than 1.5% to the downside. Its posture is obviously still strongly bearish, with the intermediate line still below market sentiment, but its market sentiment line, unlike the S&Ps and the Russells, which is barely below 60, its market sentiment line is already in bearish territory. Remember, the NASDAQ's market sentiment line is actually rising in bullish territory still. We'd have to, the near-term intermediate line just barely crossed above it. So it's actually in a bullish setup there, though we may be peaking, forming a double top. The Dow, on the other hand, not so bullish, right? The intermediate line still in bearish territory, and now your market sentiment is too. Dark pink shading and red line for most of the period. You got light green shading now, only because we're at 26 and rising. We can turn to dark pink just like that. So pretty bearish, not surprising, a bearish result to the day. Again, as we've been mentioning, as much as we really want the markets to rally, we just get fake out after fake out after fake out. You get the people on TV saying, hey, hurrah, right? And we're going to go up to new highs, and Tom Lee comes on every time we have a good period of time, and then we fake out. That's been the course of the past year, and that's what happens in bearish markets, and we haven't really even started the bearish market yet, because we haven't broken below that 200-week moving average quite yet. If you take a look at the weekly chart here, this, as of right now, this is a transition week. The difference, though, is we're not getting a bullish candle this week. I mean, just like that. It was earlier when we had a green arrow and everything, but just like that, and in the midst of an intraday move, we are done with it being a potential reversal. Like it is a transition still because it's a higher close, but we'd have to close next week above this body for it to actually be a reversal, which is more likely when you actually have a bullish candle here. But the Hakinyashi and the regular candle look very similar to each other, almost exactly the same. So that decreases the odds of having a reversal next week, which would have been really nice. If we'd have closed today above 4,000 and really ended into the weekend strong, we still could. Unlikely, but we still could finish strong into the weekend. But if we continue lower into the weekend and we end up with more of a bearish candle here, then we're going to be set up for a close back below this body next week, and which means, and the closing back below this body here means we're just back to being bearish again. So that's what I expect that we'll see. If you look at the three red arrows, the Nasdaq still has 3 green arrows. That's how bullish it was. The S&P did not get the third green arrow, nor did the Dow. They still have 2 greens, but they're, again, they're still white. They're not turning green. And then the Russell never did turn white, right? It's still got 3 red arrows, and it's looking like it's going to continue in that pattern. So 3 green arrows across the board. Only 1 3 green arrow for one of them. You can see the Dow, how significant this move was, because at the highs of the day, we were above 4,000, above this Fibonacci level, above both these Fibonacci levels, above the point of control, above the 30 and the 50-day moving averages. That would have been tremendous, especially if we could have, because we were above it before the press conference. If we could have gotten this kind of move to the upside afterwards, we would have all had Tom Lee posters in our offices and ready to go, right? But again, that's not the technical environment we're in. That's the hopeful macro environment that we can. I think I saw something today said that he said, I didn't hear him. I wasn't watching when he was on, but I heard he said that the stocks would rally regardless of what the Fed did today. And it's like, well, I guess that still could be true, but obviously it wasn't true immediately after the press conference. And here's the problem for the S&P is, instead of closing with this really good bullish close that would have been even better had we really pushed it up further after the press conference. Instead, in the last 30 minutes, we broke below. Remember, we were at 398. We were right here and going into the last half hour trading. In fact, going into right around that time, I heard Santoli and Josh Brown talking, and Josh Brown said this is like the first time that we had a FOMC decision that the market didn't go up or down 2% by the end of the day, and I kind of thought we wouldn't because of what same thing he was seeing. And Santoli had said, well, we still have an hour left of trading, or 45 minutes or whatever. We still have some time left, so who knows? And he kind of said that off the cuff, and they kind of chuckled at it because most likely we were going to finish flat in a really small range. But then 30 minutes later, we're down 1.7% by the end of the day for the SPY at least. Almost 2%, just like that. Just in a matter of 30 minutes, after everything was all said and done, we closed below the 17, the 8, and the 200-day, and the point of control, and back below this 38% Fibonacci retracement of the correction move, just like that, right? That's how things can change, and that's the technical environment we're in. It was too much of a fake out here. The Nasdaq went up too far. And that's too much, especially without the rest of the markets, as I showed in this chart here, as I showed you and I tweeted out, the Nasdaq went up too far, and now it's now you expect that it's as parabolic as it got, that it's going to probably come back down and start to correct that, which again it can correct that in a bullish environment. It's just uncommon for it to correct. The last time it spiked up without the Russell and had a really good, strong, bullish move. Here was right before we started, coming out of Thanksgiving, where the Russell broke down, very similar to what we see right now. The Russell broke down. Let me go to a 2-year chart here. And the S&P didn't. The Nasdaq especially. It was right before this all started. So going into the end of the year, going into the very beginning of the year, we had all-time highs in the S&P. Dark green shading in the green line. The Nasdaq was helping fuel a lot of that too. It was close to all-time highs, but it was pretty much at its mid-November peaks, but not the Russell 2000. The Russell 2000, after peaking in mid-November, it dropped going into expiration. It dropped going into Thanksgiving, coming out of Thanksgiving, and started a bearish trend by the beginning of the year, which is right here. By the beginning of the year, the Russell 2000 was nowhere near its November peaks, nowhere near its all-time highs. And so it's very similar to what we're seeing now, where the Russell is coming off of these highs, starting what could be a new correction to the downside. But the S&P, especially the NASDAQ, is actually it was actually kind of sitting right at those February high points, that exhaustion peak. It was sitting right. In fact, we were above it earlier today. We were above those peaks, and then now you can see dark green. No peak. Just a couple of days. Just like over here, you only had a couple of days of dark peaks shading in a red line, and again, only a couple of days. But as we saw in 2022, if the Russell is going to lead us down. After such a parabolic move on the NASDAQ to the upside, again, the last one that got above 2 on the PPO here, this one got above 3. In fact, the moving average got up above 2. Then we're probably going to follow the same type of pattern that we saw going into the beginning of the year, where we're starting a new correction. In this case, the correction that would actually take us through the 200-week moving average, right? That's the we've been trying to avoid doing that, but remember the Russell 2000 already is through its 200-week moving average. In fact, so it's down so much that the 8 days already crossed the 17, and it's crossed below the 30 and the 50, and is crossing the 200 as well. So this is the Qs on the other hand has been holding up a lot better. But again, if it fails here with that long upper shadow, just like we did over here, if it fails, then again, you would expect that it will drop below these lines to get back below the 200-week moving average, and then we're starting the bear market. We're starting that retransition from what was a correction in the bull market to the beginnings of a bear market, like we've seen multiple times in the past. All right, let's take a look at some of the other oscillators here. Let's look at the DMI. You can see that, again, the negative indicator dropped a little bit below 25, but bounced right back up. The positive got up a little bit above. This is very much a kind of a bounce type signal. And as of right now, it's bouncing. The ADX is still too low for us to be exhausting a bearish move. In fact, we haven't really even started that bearish move. In fact, the Qs actually had a bullish move, right? It's still above 30 and below 20 and expanding. So that's how much downside we could still have, whereas the Russell is still above 30 and below 20 on the opposite side. Such a divergence between the Qs and the Qs, which is pretty much 25% Microsoft and Apple, and the Russell, which obviously has such wide disparities in sector weightings there towards the mega cap names. Let's look at some of these other oscillators. Let's look at the RSI and the CCI. You can see we had gotten above 50. We've done this before, and it failed so far. We got above 0. We did not get above 150. So far, we'll see if it plays out to the downside. The NASDAQ, remember, did, but the Russell 2000, of course, did not. So, which one are we going to follow? And as of right now, you would expect that we'd follow, even before now, you'd expect that we'd follow the Russell 2000 and not necessarily the S&P. The breadth has been horrible on this rally. It's still negative. It's still down. The summation index is still below 0. This breadth has been absolutely horrible here. That's why we can't get going. The money flow has not been good either. The money flow on this little rally has not been able to get above 50. It barely got above 40. It's already back down below 40. No, the money flow index is nowhere near getting it to these highs. There is no breadth. There has been no bullishness to the move, and here we go back in the lower half of the 4-week range again, just like that. Now if we get back below the moving average, that's something more, but it looks like we're getting a kind of a failure peak here. A fake out type move with a very strong 26-day negative rate of change, back below the cloud, staying below the cloud. And we never did hit 0 on this, so we still can engage that bearish trend. The Russell 2000 actually is flirting with a very mature bearish trend, a very negative rate of change. Your Qs, on the other hand, are still actually has a positive rate of change over 26 days. So it can barely, and no trend going. So again, if we're going to be bearish, the Qs haven't even started yet. And once it turns bearish, we all know that's when we get that's when these bearish moves really kick in gear. So that's that's the expectation. Your Bollinger Bands flirted with getting in the upper half of the bandwidth and above the point of control, right back down below it, in the not in the lowest quartile, but close. You got your momentum, you got your red dots, the bands are inside, but looking for it to move below that lower band. You can see IWM, and it had such a big expansion of its bandwidth. SPY, remember, is down here, so big expansion of the bandwidth in the lowest quartile. Big bearish momentum with the bands way outside the Keltner channel, closing back below the Keltner channel, or right at it today. Again, goes to show which direction of the trend you'd expect we'd go in. The Qs had a little bit of an expansion of its bandwidth with the move up in the upper quartile here and up above the upper band and above the point of control and everything. But now, again, you got the positive momentum. If we can't keep pushing those bands through and get above the Keltner channels, then again, fake out. We've seen this fake out before over here. We've seen lots of fake outs, and this would just be another one to add to the list. I showed you the Arun indicator is set up for a bullish move, but now we're back in the lower half of the chart, filling in that gap. So not as prevalent as we could be. Like, we're below 70. So at some point in time, that green arrow can spike up to 100 if we get a new 4-week high point, which we had pretty good odds going into the press conference. Now, not so much. But we're in the middle, so we're not tanking either. And again, it's really important to see how we follow through with this tomorrow. If we can rally right back up just as fast, and great. But if we continue the bearishness, then obviously not so great. The today's volume and range was very mild, had been. But obviously, by the end of the day, a 10-point range and 100 million shares, both above average. That show you where they compare to those averages. The 10-point range here is way up here, so more than 1.5%. Actually, probably more than what 2% would be. 1% is 4 points, so 2% would be 8 points, so it's above 2%, but not off the charts. 100 million is a little bit below the average, but pretty much right at the average. So the ATR compared relative to the price is still rising. Of course, that's not bullish, that's bearish. Here's IWM and what it looks like, and you can see really rising in terms of volume and the trading range back above 2.5%. Of course, your Qs rising too, while we've been moving higher, which again is not typical. Again, another characteristic of that fake out pattern there. Finally, let's take a look at the VIX. When you look at the VIX ratio here, we were down. We were close to 20. We were flirting with break. We got to 1994. We got below 90%, and boom, last half hour trading ramped and right back up to 22. And we talked about this in our Market Scholars class at noon. We never did drop below 100. We were at 100, a little bit below, but we were kind of, that was more of an anomaly. They were kind of sitting right at about 98, 99. And so we weren't really confirming this big drop in the VIX with the tremendous drop in the VVIX. Getting below 100 is another thing, but getting to 100 is basically getting the support, which it looks like the VIX has done too. The VIX, when you look at where the VIX is, it looks like it got to its average levels, and instead of breaking through it and getting lower than average levels going forward, it looks like we might be actually hammering out a low point here at the moving average and ramping up again, which you would expect that we would ramp up, considering that we had really kind of broken the trend, and these lines are all moving higher now instead of compressing. They're all expanding. Compressing is when they come down, obviously, and they come down quickly and then they base, right? Whereas we move up quickly, we don't really peak, right? We don't really base. We just move up quickly or trend higher, and then we reverse rather quickly. So we don't really get a good convergence up here like we do when we do move lower. And obviously, we're not moving lower right now. We're still moving up and trending. This was the kind of move I talked about on Monday. This was the move on the VIX where the market was trying to front run that CPI report and failed, and then we just rallied. And I said, hey, this could be very similar. Well, so far it's looking pretty darn similar to that failed front run of what they expected would be a dovish Fed, because the Fed meeting was later after expiration. So they expected a good CPI report to lead to a dovish Fed, to a pause at least, and they didn't get that, and the volatility just ramped back up. And it appears that might be a very similar situation to what we're getting right now. All right, now let's take a look at what's driving this price action. You can see the 3-month chart, the Qs and gold. Not two things you typically put together, but those are the two things that have been the biggest outliers to the upside. On the other hand, anything physical outside of gold and the other physical, asset classes, commodities and real estate are really down significantly, down to the downside. Pulling IWM down too. You can see the dollar is now negative for the 3 months. The S&P is underperforming bonds for the past 3 months now. A little bit of a change there. Looking at today, remember this is kind of an up and down day. Up first and then down in the last half hour of trading. Let's take a look at what it looked like going into that half hour. So here we were coming out of the press conference. Stocks were flat. Gold was up. Emerging markets were up with the dollar being down significantly. It helped it lift emerging markets up there, gold and emerging markets, until the late day sell-off in risk asset classes. Look at real estate down almost 4%, IWM down almost 3%, the Qs down nearly 1.5%, all just fading sharply to the downside. And gold and the dollar and bonds really taking off. And the dollar kind of held up during that last half hour. High yield dropping, commodities dropping, but still outpacing a lot of these other asset classes. So a big drop there. Let's take a look at some of the charts for some of these different assets. Looking at the dollar, you can see the drop below the 50-day moving average and below the point of control. That has some opportunities here to be bearish. You can see the 10-year yield. Look how much it dropped, down to 3.5% again. Right there at the 200-day moving average, threatening to change its direction, whereas TLT is really on the cusp. If it breaks through that 200-day moving average and the 23% retracement level and the point of control, then long-term bonds can really take off, and that's not going to be bullish for the markets. It was bullish for it to get off of those mid-October lows to get up here, but it's not going to be bullish getting through there. Getting below 3.5% on the 10-year yield, where the Federal Reserve is at 5% and expected to go to 5.25% and stay there all year. That's not the kind of inversion you like to see. Bitcoin has had a good run lately. Really broke out a little last week with that long upper shadow, and then finished Friday above the highs and looking like it can really take off here. The MACD appears to be peaking, so that will be interesting to see if it will be able to continue to hold a lot of those gains. Again, kind of along the higher end risk asset class. It's really enjoyed this move like the NASDAQ has, up above those February peaks, right? This mid-February peak here, or early March peak. Bitcoin really got above its early March peak too, right in this area. So taking off along with the NASDAQ. Taking a look at commodities, I remember commodities don't correct in bull markets, and they are in correction mode. So last week kind of solidified that correction mode. We're up a little bit, but not even we're close to the 8-week moving average. So commodities are in the correction mode. They're below all these moving averages and heading lower. Again, that's not bullish. It's not bullish. It's bullish for commodities to be rising, even off of lows, but it's not bullish for them to be correcting and following where the S&P already is and the Russell 2000 already is down here. And then, of course, remember, bonds are way down here. TLT is way below its 200-week moving average, and trying to figure out whether it wants to break through that 50-week and get above and start retracing to the upside, right? Which is typically what happens in bear markets when it starts to move higher that significantly to the upside. So those are the different major asset classes and how they're performing. Looking at the different major markets that are out there, let's look at the 12 grid for all the major markets. You can see China up here at the top, dark pink shading in a red line. Same with Brazil. Korea is sitting there at the red. I mean, everything is like sitting right at the moving averages with either light green shading or dark pink shading and long upper shadows today. Not necessarily the best thing that we want to see here. So you can kind of see that we may be starting to hit resistance on a coordinated level all across the board. Let's take a look at the sector moves and how they perform. So let's go here first and just look at today alone, then we'll look at that 12 grid. Again, looking at today, going into the press conference and through the press conference, we were okay. XLK was really ramping up. XLC was doing well. And then boom, look at that. A big drop off in just about every single sector to the downside. Nothing was spared, which again goes to show again how bearish that was when literally nothing was spared in that 30-minute decline. So more than likely we're gonna continue this move. Whether or not we drop 2% tomorrow or not remains to be seen, but more than likely, we're probably going to start to continue the intermediate trend back down to the downside through the daily ups and downs. Obviously more downs than ups, but not devoid of ups, right? Here's the 12 grid for the sector. Again, remember light green shading and a red line here for the S&P. XOK actually looked like it's trying to double top, and then XLY had light green shading and yellow line, a little bit above the 50 on the intermediate line and above the moving average there. Dark pink shading and a red line everywhere else. So, you can see just how niche this move was. Just literally just in this area of the market. Everything else about as bearish as you can be. So, about as big of a fake out characteristic as you could possibly have right here. All right, now let's take a look at our trade idea today. I want to take a look at Tesla. Tesla has had an interesting move. It broke out yesterday, broke above the 17-day and the 30-day moving average yesterday. A little bit down today. But again, this is kind of an opportunity for us to make a trade on something if we rally, right? If today's move is at the end of the day is kind of a one-off. We've got plenty of bearish trades we've done in this class, in our Market Scholars class portfolios. We've got a lot of bearish deltas. So we're not too worried about downside moves. But we're looking for opportunities to the upside on any kind of move up. If we actually do get this move rally back up to old highs, and Tesla would be one of those opportunities. Like I said, it had a nice little rally. It actually pulled back, so it's hardly like overbought like the Nasdaq itself is. It pulled back down to its moving average, 50-day moving average, held for support, and like I said yesterday, bouncing back up above the 17 and 30, right around the point of control. MACD is rising, stochastics is in near bullish territory. So things are actually looking on the up and up here for this stock. You can see how you've got the weekly candles here showing a relatively bullish week. You notice it is a transition week, kind of like what we showed on the S&P 500. But the whoops, here we go. I don't know why it's going so slow. But the difference between this candle and the S&P is that is a bullish week as of right now, and still actually has the green arrow. We're still above the 10-week moving average. So we have a good opportunity with the rising PPO for us to get a new bullish move going if we're going to get a bullish move, right? You can see a lot of these oscillators on the pullback also pulled back, right? We pulled back down on the negative indicator, or on the positive indicator. Looks like we're bouncing back up above 25. We bounced up on the negative all the way above 30, but now we're back down below 25. So it does look like we are heading in that direction. When you look at the RSI and the CCI, you can see that they're also back into bullish levels, back above 0, back above 50, trying to work their way up to more bullish levels there, but at least they're not bearish. Excuse me, the RSI and the CCI. Sorry, that's what we just looked at. It wasn't what I wanted to look at, the Ichimoku cloud. This one. If you take a look here, again, we had a bullish trend going. It ended on the pullback. It brought the rate of change down, but the rate of change is now slightly negative, and you can kind of see for us to get positive where it needs to go back up, get towards. We had a little tiny weak, very weak bearish trend going, and now it's gone. So you'd expect that we have a possibility, an opportunity here for Tesla to really rebound very well, especially if the market itself is going to rebound. Was a lot closer to the upper quartile. You can see the momentum is trending up to the upside here with green arrows. So the bands are actually still outside the Keltner channels. So if we can follow through, if the markets can kind of not go down tomorrow or Friday and kind of rebound relatively quickly with how sharp, and again, it's just a half-hour trading. If we can rebound that sharp move back up, again, if we don't, we've got plenty of bearish trades. But if we rebound, then here's an opportunity for us to take advantage of a bullish move on the stock that could really take off. Right? I mean, this bandwidth is relatively low relative to where it's been in the past, and and the bands are just barely outside the Keltner channel, so we could really push up here and against those bands and outside the Keltner channel and start trending higher like it did here. So considering that it's not the most, that's not looking the most bullish so far, what I decided to do here is give myself a lot of flexibility. So we did a bull call spread, but we came here and bought what was at the time the at the money. It's not at the money now, as the stock is down to 190 here. But at the time, it was the at the money call option, and then you can see, we can try to get up to this 200 level, and there's the maximum gain and where it's at relative. That's how far it's dropped since we got into it. So I guess it wasn't quite exactly at the money there. But that's where we're at now, and we got a pretty decent, about a little bit more than $500 worth of reward for half my normal risk. So a little bit more reward than normal for a higher probability trade, but half the risk of a higher probability trade. And that's the flexibility we have to work with if it doesn't quite take off right now to the upside. And it doesn't have to go up a lot. And if it does, then as we get into this May expiration, we can really do a little bit more directional of a move if it actually does take off here. And keep my risk really small if it doesn't. And knowing that, again, like I said, I have plenty of, especially even in these videos, we've had some recent bearish trades that would work out very well if this doesn't take off. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join our website at marketscholars.com for free. Follow me on Twitter, Facebook for more content, and like us there too. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.